Hello, hello, hello. Mic check, mic check. 1, 2, 3. How's everyone doing today? Welcome to Al Stock Trades. My apologies for the late entry here, guys. I was planning this video and a couple of clinical things ran up, but we're here. Let's get started. All right, folks. So, as always, it's a pleasure to have you on. My name is Al Stock Trades. I'm both in the healthcare field as well as the stock market, and been in this game for quite some time, and always like to be able to share my thoughts, and definitely want to talk about this. So I've been no stranger to SoFi. We talked about it when it touched in the $20 plus region. We went ahead and talked to retail investors and educating them on how it was actually overvalued at that stage. Stock collapse got into a wonderful level where we said this is a great opportunity. So what we're going to do now is we're going to do an intrinsic value calculation, a breakdown of the fundamentals of SoFi, and let's go ahead without further ado. Let's get it done. So first things first, we're just going to basically set this up, and we're going to explain kind of what happened in the past couple of days, just really quickly, just for folks that just don't know what happened to SoFi. Most likely, if you're watching, you probably understand exactly what happened. But again, there's some folks that don't, so let's just go ahead and bear. So overall, SoFi is only down negative 3% by all accounts since it's basically last debuted. But if you go to peak to trough, it's actually down a little bit more, around 59%. If you go to year, SoFi's up 22.48%, but year to date, it's actually up 124%. Being that if you essentially purchase SoFi at a wonderful price of $4.32, it was actually a lot lower. It was actually $44.24. And if you go to peak to trough here, you're definitely sitting pretty good, right? So the whole point of doing an intrinsic value calculation is to basically find what is the value of the company I'm holding. And what you'll basically realize is an intrinsic value calculation helps you know when to leave a stock, or at least know when not to buy more of the stock, because it gets to a point where it's overvalued based on its current fundamentals. Because what the point is a lot of folks, what they do, and this is where retail investors fail, is when they see a stock go up, especially in the short period of time, they believe the stock is really good. It's a good stock, and the price is going to continuously go up. It's almost like thinking like your 20s and how you're in your prime. It's only just going to get better in your 60s, right? It's a fallacy, and it can generate this thing called FOMO, right? Fear of missing out. And you want to be able to sell to that. You don't want to buy into that, right? You want to sell people that, right? So that's what we try to basically talk about. So let's go ahead and just look at this beautiful presentation I put together. Let's talk SoFi stock, right? So this is going to give you kind of a 2-week glimpse of what happened. So SoFi shares dropped around 8% when a particular company underperformed. It said it'll underperform the market. Now, we don't know. I take this as a grain of salt. We don't know if this company is short or they want to get, they're selling cash secured puts, which they're trying to collect premium off of the stock going down. But at the same time, they want to buy the stock and they want it to essentially drop, but they're still bullish on the company. We don't know the intentions of these folks. And, the SEC needs to get further regulation regarding this, but until, I wouldn't hold your breath on it. So recent performance, the stock has written 120%. But we saw it risen more, and it's trading more than 30 times EBITDA, right? So analyst comments, they note that there's a high valuation relative to the balance sheet and expects modest profitability by 2024. And again, a lot of companies that we are looking at are expecting profitability by 2024 with a return on equity in the low single digits. Contrast ratings, they're underperforming. And a couple of analysts are basically, if you scavenge the internet, they're essentially doing a buy and a hold. So everyone's kind of all over the place. So I just wanted to add my insight here. What's up? What's up, Irish? I'm glad you're here. So overall, Q2 exceeded the Wall Street's performance, and personal loan originates climbed, attracted new members with good credit scores. Okay. And we need to look into this a little bit more. Sometimes it's important to look at how, who is actually getting these loans and if they are actually good credit worthy folks, right? This is a little bit something you got to dig in a little bit when it comes to these types of bank stocks. All right. So the adjusted net revenue for 2023 expected at 1.97 billion to 2.03 billion. It essentially raised adjusted EBITDA outlook. And you could go ahead and we could go over it. It's definitely important. So they added around 500,000 members on average up. They're growing rapidly, I would say. Total deposits increased by 12.7 billion. 90% of SoFi money deposits are direct deposit members, so they're not going anywhere. Origination volume Q2 was 4.38 billion, up 51%. And again, the whole thing also, student loans repayment just basically started. So this is another kind of tailwind for SoFi to continue to grow here. So, this reiterates the 500,000 folks that increased their Q over 44% to over 6.2 million members based off of the new members added, products added. And this is what future management expects to generate in terms of the adjusted net revenue. But the biggest thing I want to basically talk to you guys about is the overall increase in revenue, which is 37.3%. I want you to remember this number, 37.3%, because this is going to be part of our intrinsic value calculation. I want to honestly skip this over, but again, just to give some background for folks that don't know anything about SoFi, I think this is some useful information. But the biggest one is I want you to remember the 37.3%. And you can also find it right here also. And also our stock terminal, which you can find out stocktrades.com, 37.3%, right? So 37.73, sorry. So we're going to basically go directly here. We're going to say 37.3, right? Let me just double check. 73. I'm so tired. 37.73. Right. So there are a bunch of sevens there. 37.73. So it rounds it up to 38, but it's still in there as 37.73. So now that we put in the growth rate, now what we're going to do is we're going to look at the financials here. Okay. So we're going to look at the revenue. We're going to look at the gross margins. The gross margins are beautiful. This is exactly what you want to see, right? Great gross margins. Earnings per share is still negative, and net income is still negative, and free cash flow is heavily negative. But again, guys, it's important to just understand that they are going to be profitable by 2024. What we're going to take from this is the shares outstanding, which they have around 527 million shares. So we're going to go in and we're going to put 527 million here, okay? And now the whole point is we want to go 10 years into the future. And by doing that, we're going to go all the way up to 2033. I know it says 2032, but it's 2033. And we're going to go in and calculate now the free cash flow. The problem is if you look at the free cash flow, SoFi is actually negative free cash flow. So what we do here is we do an estimated free cash flow of looking at 5%. Now, again, if it becomes profitable, like in 2024, we can assume that most likely the percentage of the revenue will actually be higher for free cash flow. But again, we don't want to make those assumptions until they're actually free cash flow positive to see exactly how they're growing at in terms of the percentage of the revenue. So we're going to do the standard 5%, which is, what a lot of Wall Street hedge funds actually use to estimate these things. And this is me going through hundreds, if not thousands of calculations to understand how to evaluate a company. Okay. So we went ahead and pretty much basically talked about all of here. This company doesn't have a dividends. There's no payout ratio. You don't have to worry about that. It's more for growth, right? And we know they're growing fast. They're growing at little 37.73%. So now we're going to go to their their expected net revenue. So they're expected to grow to 1.97 to 2 billion. Full year 2023 adjusted revenue is going to be anywhere between 1.9 to 2, right? And if we were to look at it here, we can go ahead and we're going to just go ahead and put $2 billion, okay? And we're going to take 5%, which is 0.05, and we're going to multiply that out. We're going to multiply that out with the 5%. Sorry, guys. Just redo that. I got too excited. We got 100, right? So we're just going to put 100. We're going to just average it on the green part here. By putting 100, this is exactly what we're looking at right now for SoFi, right? We're looking at an expected recession case of $6.87, a bear case of $14.87, and a base case of $20.74, with a bull case of $30.89. We're expecting them to grow at $2 billion. Now, personally, I like to look at trailing 12 months. And if you look at the trailing 12 months, which unfortunately, this is not showing. Let me go ahead and stupid PowerPoint changed the thing here. So there it is. You see how now it shows? PowerPoint removed it. So now let's go ahead and take a look at it. The shares are actually 929. They're not 527. So let's go back and go 929. So that's why I was like, this doesn't make sense. So 929 million, right? Almost a billion shares. By doing that, now we go in and we look at a recession level of $3.90, a bear of $8.44, a base of $11.77, and a bull of $17.53. The stupid PowerPoint cut off the TTM. That's what I use. So I know I use 2 billion, but I'm teaching you exactly what Wall Street does. We do not look at, we like to see the money up front. We're not going to use what they expect. We're going to use what they actually earned thus far in the past 12 months, the trailing 12 months. It's 1715. So you go here and you type in 1715. By doing that, you get 85.75. So now we're going to put 85.75 as the estimated free cash flow. By doing that, you get a base case of $10, right? A bull of 15 and a bear of $7.23. We're not in a recession, so we're hovering now between the base and the bull. Now, if you go to SoFi and if you go to their most recent high, they are up. Let's do like 6 months here. They went up to $11.70, okay, which is right between the bull and the base, okay? But here's the thing. We're expecting that SoFi is going to grow at 37.73% for 10 years. And that's very difficult for a company to do. So another calculation which you can do on top of that, we can say, well, let's say if SoFi achieves 75% of that, we can expect them to grow at 28.29%, call it 28%. And this will give us a direction on the most bearish case, and we can go ahead and give the standard case. So the most bearish case is pretty much right around this base case of $5.27. Based off of this, I expect a 15% return year over year at $5.27. But again, we know that's not right because as soon as it hit $5, it basically shot back up because the value is it's more valuable than $5. But, what this basically tells you is normally if it's a value company, you should expect 15% because the discount rate for the base is around 15%, right? If not 20. And what we can do is we expect 15% year over year. But with things about growth companies is you can treat them and quantify them as value companies, but you have to understand is once you calculate the intrinsic value and you actually buy under that, you know that it'll go up to its ascending value a lot faster than that, let's say, of Coca-Cola. So we know that it's growing, as of right now, it's growing at 37.73. Okay? That's what it's growing at, right? And we know that SoFi has actually grown more in the past, I think in the 50% range. So we can see that's why the stock, when it was basically focusing on growth, shot up in the 20 plus region. Now, can it grow back up to the 50% range? It can, right? But what I'm trying to tell you is be careful because if you buy the stock at, $15, $22, or let's say $33, you're expecting that it's going to grow 50%. When you buy, there's always a buyer and a seller in the market. And whenever you buy a $20 stock from SoFi, you're pretty much the buyer saying, I'm going to sell you a stock that's going to grow 50% for the next 10 years. And you have to understand that that's physically not possible for 10 years, maybe in the short term. So you can use these intrinsic value calculations to basically find stocks that are undervalued, buy them, and within 2-3 years, they shoot up really quickly, and some within a quarter. And then some, unfortunately, my apologies, dumbass comes, wants to buy the stock because it just went up 150% plus, and you can hand it to him and then let him hold it while you take his money. And then let's say if it crashes back down to back to its base value, then he'll most likely sell it and be like, this is a POS stock. And then you can take it back from him and rinse and repeat. Okay. All right. So I hope that makes sense. All right. So let's go back to 37.7. I know we're jumping around doing a lot of numbers here, but I'm just trying to show you how you can use this. And you have to do multiple calculations because look at how effing volatile the stock is, right? So based off of this, the stock's base is $10, which makes sense because look at what it's trading at right now. It's trading at $10.08. And our intrinsic value calculation, what does it say? $10.09 effing cents. Literally a penny off our calculation. And all I did was just put in the financials, use the equation I've been using for 10 plus years, and then calculating it. And it shows me what the base value is. So, you know, and the market hasn't yet priced in a bull market. It is a bull market based off of the simple moving average being over 200. But again, there's still some uncertainties with the whole downgrade from AAA to AA, whatever that's so stupid. You know, it's retarded, right? If the freaking United States government fails, they'll just print more money, right? And if China coughs, we'll just show them our nuclear weapons and muscles because we're the strongest nation in the world. We dictate what the dollar value is going to be. So I don't buy the whole downgrade anything. It happened back in 2011, and you can see what happened to the stock market after, or whatever, 2011, 2012. But overall, you can see that our base case is literally a penny off from what the actual closing price is, right? So this is important because when the stock shot up to $11.70, you can quantify this and you can say, okay, well, I'm going to put, let's say 20%, $15. I'm going to sell it at that, right? Because I think that's really the value right now for the next 10 years. And I'm going to sell it there. And then once it comes back down and people basically sell it off, the guy who bought up here and then all of a sudden sell, they're down 11.97%. And then if you were to go from that angle to back to that price, it's a 20% gain. So let them lose their 10% and you'll make that 20% because it will basically keep oscillating, right? But I wouldn't recommend doing that, obviously, in the $5 region because that's just stupid because the price is low enough. So let me go ahead and look at the comments. Decision on student loans was released after Q2 end. Yes, sir. What's up? Never catch a live stream. Hey, it's nice to have you here. Free cash flow isn't a great way to measure SoFi cash position. Well, here's the thing. We're looking at an intrinsic value calculation. And I think based off of what we're getting, I think it's a phenomenal way. And I've been doing it for the past 2-3 years for SoFi. And it really hasn't stopped me. But you are correct when it comes to bank stocks. Normally, there's another way of evaluating a bank stock, but you have to understand SoFi is a growth company. So we couldn't evaluate it like such. SoFi has only shown its ability to grow and diversify its revenue streams in some of the most difficult circumstances. And I agree, completely agree. Yeah, we have a submit your own stock for educational purposes on our platform. You can check it out. Every downgrade red market lasts about 2 weeks. Exactly. Yeah, exactly. Just buy. Again, you can, but there's a better way of doing it, right? And this is what billionaires use. This is exactly how you traverse this because like for example, the people that did this calculation in our group, and I think Irish Vanity was one of them, he said, oh my God, SoFi is undervalued at $4.77. And if you go to CNBC, they were telling you to sell, right? Because that's what they do. For the people that bought, well, congratulations, you're up over 120%. If not here, you're up literally, if you go up to peak to trough, 140, right? Percent. All right, let's go ahead and take a look here. All right. So that's it. That's all I have for you guys. If you really enjoyed this video, please give it a thumbs up, like, comment, subscribe. It helps out the channel. Again, we're not looking here to make money off of your views. This is just a way to basically share with you guys how I look at these types of things. It's another perspective. You don't have to take it. You could just toss it in the trash. But it's pretty impressive how our base case was $10.09. And it just so happens the stock closed at $10.08. And it's literally a penny off. So that's pretty impressive. What could change these types of things? Well, assuming, let's say, they grow more than the 5% of estimated free cash flow revenue. Let's say they grow at 10, 15%. Well, obviously the free cash flows are going to be higher, which then that's what most folks, that like the guy who just says, Mr. Lee saying just buy and buy, maybe they're expecting a higher free cash flow. But again, it's always good to be conservative because, again, rule number one, don't lose money. Rule number two, don't lose money. And, you want to basically be able to look at these and kind of have an understanding of what's kind of undervalued, what's moderate value, and what's overvalued. And if you want to buy this at $20 or $25, that's a little too overvalued for me, right? But again, more power to you, right? Because remember, Chamath sold at $20-ish region because he knows how to do an intrinsic value calculation. He talked about it in one on a podcast that he joined, right? So this is something that you want to basically know about and use. And we do teach this. You can find a link down below on our website, Al Stock Trades. We've been featured on Yahoo Finance, Benzinga, Bloomberg, and a whole bunch of reputable journals. You can find more information if you're curious and want to learn and invest in yourself, which is honestly the most yielded result, right? But overall, guys, it's always a privilege and honor. And I hope this video was of your liking. And definitely please like and subscribe. And I'll see you on the next one. Peace.